All right, our first question via email from Pierre. Simple question, but it comes with a lot of different things. Pierre wanted to know, in your opinion, what is the best income method to generate steady income? He says, right now I'm doing cash secured puts and covered calls, but I'm getting assigned very often on the cash secured puts because I'm targeting a 2.75 return. Which means he's looking for about a 2.75% naked yield on his positions, which when I ran the search earlier that we created, that we're going to review in just a moment, that usually ended up being somewhere around probabilities of a 60 to 65%, 67% probability of expiring worthless. To get that return, he's closer to at the money. This might relate to a delta of maybe 0.4, 0.35. Where many naked put traders might go further out of the money with a 0.3 or even a 0.2 delta or 70 to 80% probability, but they likely won't be seeing a 2.75 naked yield for a monthly position. And the covered calls, he's aiming for 1% monthly and still getting assigned. What does that mean? Well, on the covered call structure, if he's looking for 1%, I think we're talking about the time value premium that Pierre is looking for, which probably means he's selling an out of the money, maybe buying a stock at 50, selling a 55 call to generate just 1%, hoping it expires and continue to do the trade. But he's still getting assigned on the upside. He says, with your experience, what is the best income generating methods with the least of risk of being assigned and still getting a good return? All right. My common answer, and many of you know this, it's going to be out of the money, high probability bull put credit spreads. But that's just me looking shorter term, 14 days out in time, 15 days out in time, 85% probability, still targeting 12 to 15% return on that position, but it's shorter term, out of the money, higher probability. And that's the way to go. But there's nothing wrong, I don't think, Pierre, with your covered call approach or the naked put approach. And personally, I don't see the issue with being assigned because that's the max return. I understand the issue of being assigned on a cash secured put. That means the stock fell. You had to take assignment of the stock. But on the covered calls, that's kind of what we want to have happen. And I'm going to explain that here. Now, I spent most of today, a good portion of today, between other phone calls and emails, running tests using our testing services. And we created searches here for what Pierre was kind of looking for. Monthly out-of-the-money covered calls with at least a 1% time value. But of course, we don't want some volatile stocks. We're going to want some quality stocks, and we're probably going to want to avoid earnings. We've got to take that into account. Then, of course, we look for monthly cash secured naked puts with a minimum 2.75 naked yield, return against the strike price, the cash secured strike price there. So we're looking for almost a 3% naked yield with the cash secured puts in a 30-day period, looking at out of the money covered calls above the stock price with a 1% time value. But if we got assigned, it would be higher because we'd get that intrinsic gain. Now, basic criteria. We created the two covered calls. We're going to review the criteria that I used right now, and then we're going to review the results of these screens. For the covered call screen, of course, we looked for positions that were just 1 month out in time. Looked at June when we created the search. We wanted the 1% time value. We restricted implied volatility because we didn't want to see a lot of biotech stocks, pharmaceuticals, things that might have an FDA phase 2 or phase 3 approval coming out. Also wanted some downside protection. Not going to get much with an out-of-the-money covered call, as you do with an in-the-money covered call, of course. But we want some. Return if assigned 5%, at least 3% out of the money. Now, I put in a basic option bid price of greater than 0. So we didn't see something that was so far out of the money that it had a 0 bid and a $2 ask. There's no guarantee you could get the price on that. It's not actively traded. And we restricted the bid-ask spread to be less than 50%. So we're not looking at things that are too wide. We want some volume, just basic volume today, and some basic open interest. Common covered call approach, the 1% time value that Pierre mentioned. We know we're going to be out of the money. But I want some stock criteria as well. We look for stocks that trade more than 1,000 shares per day. Historical volatility, we also restricted that. Hey, I want a stock in an uptrend. These are both neutral to bullish strategies. I don't want something that's in a downtrend, maybe something that's channeling, but I want to look for something that's an uptrend. Kept the stock price between $10 and $200. We also look for stocks with a positive earnings per share growth, mid to large cap stocks, and no earnings between now and expiration. Don't want that surprise in either strategy. So that's what we look for with the out of the money 1% covered calls. For the naked puts, similar structure. We're going to limit implied volatility, but our naked yield is going to be greater than the 2.75%. This means the option premium we're collecting divided by the out of the money strike price put we're selling, our obligation. We'd have to put up the cash amount to buy shares of stock. So we want at least about a 3% return, 2.7% return. Similar requirements for the bid price, bid-ask spread, and I did force it to meet this criteria, but have a probability above 65%. This limited the first search, or when I ran this search today for June expiration, it limited it to only 28 results, because there's not that many that are going to have a 70 or 75% probability while still giving the 2.75 naked yield. Basic volume and open interest, and similar stock criteria. Uptrend between $15 to $200, not between now and expiration, avoiding any stocks that have earnings between now and expiration. Okay, so we ran these searches using our tools starting on December 18th, 2020. Why did I start there? Well, I wanted to run the search to get the January expiration so we'd have a valuation of about 5 months of trading. January series, February, March, April, and almost halfway through May to the June expiration right now. We ran it through and then simulated if we closed it today. All right. So the covered call results. This is a printout that comes out from our background strategy testing service. I did not use any stop losses for this approach based on what Pierre was kind of asking about, or the naked put approach. There's our time frame, 12/18, 5/15, the last search that was run, so it's about 4 months. And what I'm going to do here is we started off with a cash on hand of $100,000. We were going to allow 4 trades each expiration cycle, opening the Monday following expiration, the standard expiration. That's why we chose December 18th, the third Friday of December 2020. So this technically the first results came on the 22nd or 21st, excuse me, of December. We're going to allow it to open 4 trades, and we're going to put an equal cash amount of 25% into those 4 trades that match this criteria. At the end, over 4 months, covered calls were, the portfolio had a value of $108,000, so about an 8% return in 4 months, averaging about 2% return per month over the 4-month cycle. The win-loss ratio, honestly, was not great. I was kind of disappointed in this. It was 10 out of 10. 50% win-loss ratio with 20 trades made, but the average return on the winners was 11.7%. And the average loss on the losers was only 8.7%. Okay, that's still a manageable covered call approach. It's not sticking out to me as great, but it's meeting the targets of generating income. 2 out of the 20 positions were assigned. I'm not saying mine is better than Pierre, but those 2 positions that were assigned where the stock moved up to the out-of-the-money call strike price and we were assigned on the stock for the max return was over a 20% return on the position. It averaged about 20%. I think one was 20.7, the other was about 19.4. Okay, so those were the ones that were assigned. There were 10 losses. Some of them were pretty high. One of them was about 19%, but a lot of them were only 1%, 2%, because the stocks didn't move that much. Okay, so this is reasonable. We did get assigned on 2 of the 20 positions, but that's okay. It was a 20% return. I don't mind being assigned necessarily, even if I wanted to hold on to the stock, because I'm pocketing a large amount that's helping lift up this entire performance. That 50-50 win ratio was not good. I'd have to tweak other criteria. All right. Okay, but let's take a look at the naked puts. Same time frame, 12:18 to 5:15. We're going to allow 4 trades to be opened again. We're going to allocate 25% of what we started with to the positions, starting again with $100,000. For the naked puts, looking for that 2.75% naked yield, 65% probability, with just looking for stocks in an uptrend and avoiding earnings. The portfolio today would have been at 116,690, so a 16.7% gain. 85% success rate, 17 wins and 3 losses. Average return on the winners was 4.2%, much less than we saw with those covered calls, but the average losses, because we gave ourselves a little bit of cushion, we were out of the money on the naked put. So if a stock fell 4 or 5%, we still might be easily at a break even, because the premium we collected, we might have been 3% out of the money. There were 4 out of the 20 puts assigned, or 20% of the total trades over this 4-month period. But even though 4 out of 20 were assigned, only 3 were losses. One of the ones where the stock fell and was assigned, it was about 32 cents below the put strike price. The premium taken in was about $1.60. So it was still profitable to about a 1.2% return of the obligation for the naked put position. So again, the concern here with Pierre is consistent returns. We're looking at an 85% success rate here in this structure, and only 3 losses. And we're seeing a 16.7% return over a 4-month period if we started on December 18th, 2020. It's about 4% per month, a little bit more than 4% per month. 4.2 as a matter of fact, if you kind of look at it that way. That's kind of consistent, I feel. But let's take another route. On PowerOptions, Ernie spent a lot of time developing these picks of the day. And I mean, a few weeks. And what he did is use that testing service we just sort of showcased. And he ran various iterations, about 80 iterations for monthly covered calls, weekly covered calls, monthly naked puts, and weekly naked puts. And he called them the picks of the day. After all the iterations, he was looking at out of the money covered calls, at the money covered calls, in the money covered calls. Should I manage at a 5% stock drop? Should I manage at a 10% stock drop? Should we avoid earnings? Should we not avoid earnings? And he went through all these iterations for each one. And the covered call picks of the day that he came up with are slightly in the money for both the monthly covered calls and the weekly covered call picks of the day, and as well as the naked puts. Those are out of the money. Different than what Pierre's approach was, in the sense that Pierre's approach, he's looking to sell out of the money calls just to generate a 1% income. Here's the same time frame, 12/18 to 5/28 roughly. So we added a 5th month in. I accidentally went to 5/28, so we had half a month in. But again, over roughly this 5-month period, Ernie's approach that he talks about in the covered call picks of the day write-up is you're going to take the top 3 covered calls, you're going to allocate 33% of your portfolio, and you're going to close the positions if the stock drops by 30%. That's the approach he used, where he saw the highest return over his tested period. In this 5-month period, we had an 83% win ratio, 15 wins and 3 losses, and that portfolio went up 43.7%, 9.4% on the winners, 7.1% on the losers. 2 stops were hit. Why don't I show how many were assigned? Well, the goal was to be assigned. About 15 positions were assigned for at or near the maximum profit. That's what we wanted to have happen. We're not married to the stocks in this approach, Pierre. We're not holding stocks longer term and just trying to sell to get an out of the money 1% premium and just keep selling on that stock. We're going into new stocks that match the criteria with the slightly in the money structure that we found maximized return over time. And that's essentially what we're looking for in those situations. Okay, that's what the picks of the day are looking at. Now, you would ask the question, what is a good income strategy for consistent returns? And I said bull puts. I haven't even talked about those. I ran out of time to run the same 5-month bull put credit spread. I'll do that for you all later. Here's the most recent test that I did. There was another one. It was just same results, but it was from July 2020 to November of 2021. It's very similar numbers. I did that for a customer, but here's the 2020 full year test for the default weekly bull put credit spread search that we use on PowerOptions. In this case, we would take the top 3 trades. But spreads are much different than covered calls and naked puts. I know we all know that. What do I mean? Well, in a spread position, if the stock falls 5 or 6%, I might be at a 50% loss on that leveraged credit or leveraged debit spread. In a naked put, if I started 3% out of the money, generated a 2% premium, and the stock fell 5%, I'm pretty much at break even. I didn't start really losing on the trade or be threatened to be assigned until the stock fell 3%, and I'm sitting on 2% of time premium that I collected in. Whereas a spread, I might be looking at a 50% loss. So if I start off with a cash amount of $100,000, I'm only allocating 15% of that total portfolio to a leveraged spread structure, maybe even only 10%. Because at one point, there's the potential that this portion can be down 40, 50, or even 60%. And I only want that to represent 15% of my total portfolio. So if I have a bad cycle, a black swan event, which happened to us twice in 2018, this portion I'm allocating is down 50%. But because it's only 15% of the total portfolio, even in a black swan event, is only down 7.5%. And I can stomach that and continue to move on successfully without having to start over essentially from scratch. Long story short, starting with $100,000, but allocating only 15 to the top 3 trades over that 12-month period from December 30th to 2019, essentially to January 1st, 2021, the portfolio went up to $158,000, 58.3%. You could argue that $58,000 increase is 289% of the $15,000 you started off with, but I don't look at it that way. We're looking at it as a 58.3% gain. As you'd expect with high probability positions, 70 wins and 9 losses or an 89% success rate. The average return on the winners was 19.5%. Positions fell against this. This is the lie of leverage, which again, only 15% of your portfolio should be allocated to these leverage spreads. But the average loss for the 9 losses that were hit was 39.5%. All right, so that's a lot of numbers I just threw at you and a lot of concepts. Let's table that all together. Guessing on basics of criteria that I would use for a covered call, and what it sounded like Pierre's approach was looking for that 1% time premium, didn't want to be assigned. That tells me he was looking for out-of-the-money covered calls. He mentioned the 2.75% yield naked put positions, which meant that we saw we were only looking at a probability of 60 or 65%. I didn't have the test results done at 428. At 415, they just populated and finished running for the naked put picks of the day at 425. So I didn't have a chance to put the slide in together. But here's what we have. Let's review the question again. With your experience, what is the best income generating methods with the least risk of being assigned, don't necessarily mind being assigned, and a good return? Well, the 1% out of the money naked put only had an 8% gain over our 4 or 5 month period, 50% wins or losers. Probably would have to tweak that criteria, as I mentioned, add some of the things maybe Ernie was using in the picks of the day, so we can kind of see why. A lot of this is that only 2 out of 20 times, 10% were the covered calls assigned in this case, because we were using the out of the money. Those that were assigned were about a 20% return because the deep out of the money aspect gained intrinsically on the stock, plus the little premium 1% that we received in time value. The naked put structure, 2.75, that saw a 16.7% return with an 85% success rate, but 4 out of the 20 were assigned. But one of those 4 was actually assigned and still a profit of about 1.2%. The monthly naked put picks of the day during this 5-month, 4-month time frame were about the same return, a 15.4% with an 83% success rate. 3 out of 20 were assigned, where the stock ended below the put strike price. And that's okay. It could be converted to a covered call now, or you could just take the loss and you still be reholding most of the profit that you've gotten on the other positions. Then the monthly covered calls up 43.7%, 83% success rate on the wins, and about 82% of the positions were assigned because that's the goal. We've done webinars recently on comparing in the money to out of the money covered calls, that the out of the money covered call doesn't give you protection in volatile markets. You may see a higher return, and we saw two get a 20% return with the out of the money covered call here when they were assigned. But you get a 50% success rate. Going in the money, having a higher downside protection for when the stock moves against you, and still targeting a 1%, 1.5% return if assigned, panned out really well in these last 5 months for the monthly covered call positions. Picks of the day that we show in PowerOptions. Following Ernie's rules of course, getting the stop if it dropped 30% or more. And then the weekly bull put, sorry, didn't have enough time to do all the tests right before the webinar began, but the last test we did for the 1 year for 2020 was a 58.3% return on a $100,000 portfolio, but you're only allocating a small portion, 15% to that, 89% success rate. Were there some assigned? Yeah, so about the 11% of the trades that were losers would have been assigned in that case, okay? And they are not assigned, they're closed. Once a target's hit on the weekly bull puts, when the stock reaches within 1% of the short put strike price, or the bull put is at 50% of the maximum loss, it's usually closed. Okay, so it's not assigned. We don't allow it to take assignment in that case. Stephen asked a quick question. Was it Stephen? I'm sorry, there's 3 questions that came in. Okay, there was one that said just whoa, yeah. But Stephen said, are those returns surprising to you, Mike, meaning the monthly covered calls, picks of the day, and the weekly bull puts? No. You have heard me mention that we're finalizing the bull put product that we're working on, which focuses on this structure that we like to use, that we prefer to use. This is about common for the years that we've been trading and testing it. I don't trade it every cycle. Sometimes when the stock is below the, if the SPY is below its 20-day or 50-day moving average, or the market sentiment tool has a sell warning, I won't enter bull puts in that cycle. So there's some cycles that are missed. But on average, what I will say surprised me, Stephen, about the bull puts for 2020, 2021, remember, it was a 19.5% return on the winners on average. And to me, my average is usually around 15%, 15.5% from when I've been trading this and testing this from about 2016 on. And the average loss was only 39.5%, as you remember. We just saw the average I see is about 48, 49% on the losers, with about an 86, 87% success rate. Some years it's 83, some years it's 89, but it averages out to about 86%, I believe. And the numbers are fairly comparable. The monthly picks of the day for the covered calls does not surprise me. I've had questions come in the last couple of years, especially during the downturn, when investors said, hey, over the last 5 or 6 months, say a year ago, the last 5 or 6 months, I was doing the picks of the day. I had 2 that went against me. I don't see how this is profitable. And then I'd run a test over a 6-month or 8-month period and show them, yeah, you had a bad cycle, but if you had stayed with it, you'd still be a similar. This is higher. I will say that, Stephen. This is lightly higher than I expected. But again, the market's been kind of up with 2 little hiccups from December 18th through May 5th. Okay. Which does bring me to the next point on this conversation here. Just want to keep in mind that past testing results are no guarantee of future performance. These test results shown today were based on the questions posed to us regarding OTM covered call and OTM naked put approaches and other ideas for consistent income. The base results were tested against our default searches and PowerOptions over the same time period to give a gauge of the concerns Pierre had of getting assigned, and can he still be successful with maybe being assigned on those naked put positions or those covered calls, with me taking a guess and taking a look at it saying, maybe it's okay to go in the money with the covered calls and look to be assigned. Maybe it's okay to get assigned on the naked puts 15 to 20% of the time, because you might not still be at a loss at those, or the loss you're taking might be very, very small. I used some other criteria, of course. Now, the exception, the bull puts were 1 full year of testing how we'd run the weekly bull put screen. And that was from, of course, as you saw, the end of December 2019 to the 1st of January of 2021. As we all know, options involve risk and may not be suitable for all investors. Now, we do offer backtesting historical tools and power options. What I use today to quickly run through these tests, it wasn't always as quick as you saw because I didn't get a chance to do the just 6 month out. I have the full report of the 5 month, naked put monthly picks of the day. And you saw those numbers there on the table. But I did not get to do the 6 months of the bull put weekly credit spreads. We'll have to apply that later. This is a service that we offer that's different than the manual backtesting tools and power options. If you go into the power options store and click on strategy testing and optimization, you'll see what we can offer you here. If you want a covered call search analyzed, if you want to say, I want to see what the results are over 2 years of this covered call search that I've saved in my power options account, but I want to include stops of X, Y, and Z, well, we can do that for you in a one-time shot using the strategy testing service there. The other service is Ernie will look at it for you and run your search with your stops, and then he'll make adjustments to the criteria to try and improve the results on the position as well. So that's much more involved. That's why that one, the strategy optimization, is much more intense in that case and much more work. Pierre's quick follow-up question in this case is, how do you structure your OTM bull put credit spreads? Well, as anything on power options, it's shown right here for you. If I go to bull put credit spread and I go to search. Okay, so here's the search results that we use. The weekly bull puts, we're actually looking 2 weeks out in time because, as I had mentioned, Ernie did the covered call picks of the day, various iterations, Pierre, to find the one that matched the best return. I did various iterations for the bull put credit spreads, meaning that I was looking for positions 5 days out, 14 days out, 11 days out, in a sense. If you open Friday or if you open Monday, is it better to open Friday? Is it better to open the following Monday? 21 days out versus just monthly. Okay, and so what we're looking for here is minimum percent return of 9, minimum credit 20 cents, 8 to 17 days out. So we're looking at 14-day out, 2 week out spreads. 85% probability or higher, strike difference greater than or equal to 2. And then we've got some basic technicals in here. Stock price trading above the 20-day moving average. Positive MACD cross signal as well. No earnings between now and expiration. And we're avoiding indexes and ETFs to do the stocks to find the higher returns. This is the bull put weekly criteria that was used, again, with some of those stops and considerations, so we don't take more than that. And for the covered calls, if you go to the monthly picks of the day, you can click on see how we develop these results here, this text link. This gives you Ernie's write-up of what he did. But if you want to see the structure, Pierre, just go in a covered call, go in a search, the picks of the day, that's just the quick view to see what matched. But here in the search, you can also select the monthly or weekly picks of the day. And then you can see the specific criteria that's used right here. Again, it's looking for a minimum of 0.8% return assigned, 2% downside protection. Bid price of 85%, at least 10% in the money for the monthly covered call positions. Some basic criteria: positive MACD, 5 days over the MACD cross signal, stock price greater than the SMA 20, and of course, avoiding earnings between now and expiration. So that's all shown right there on Power Options, the specific criteria that are used. Here's an example. I'm sorry, you probably wanted a more specific. Chris came up today. Right now, stock's at 1440. This is the monthly now. We'd sell the June 12.5 for 278. The stock stays above 12.5. At midpoint, we're going to make a 7.5% return if assigned, and we have about a 19% downside protection, meaning the stock can fall 19% before we're worried about losing money on the positions. We're starting out about $2 in the money, but getting a premium of 278. High downside protection, relatively strong percent return if assigned. And then, of course, we saw the success rate of what would have happened with this over that last time period, the last 5 month period as well. And of course, I guess while I'm there, I should go back to bull put credits. Yeah, Roku I might move away from, but again, stocks at 346, selling the June 315, buying the June 312.50 for a net credit of 43 cents, 20.5% return, and an 85.8% probability the stock will remain above sold put strike price. Okay, so the stock could fall now to 315. Actually, it was about 318 is probably when I'd start being concerned and looking to manage the position. So it'd be almost a 30-point drop before I'd be concerned in that situation. Okay. All right. So that's just where they are, where you can find the criteria they're used. The write-ups for the descriptions there. Also, as I mentioned, that monthly picks of the day quick view, weekly picks of the day quick view. Same thing for the naked puts, but you can see the search criteria appear just by going into the search screen as well. All right, so great. You're welcome, Pierre. I hope that was educational for you and helped answer your question.